Welcome to The Explainer. Today, we're completely bypassing the surface-level news cycle to uncover something much deeper. We're getting into the institutional blockade playbook that is absolutely dominating the 2026 geopolitical and financial landscape. Look, we all know the headlines: U.S. flagged ships requiring escorts, regional ceasefires falling apart, but we need to break down the massive structural disruption happening right now in the Strait of Hormuz. Because the truth is, while everyday traders are just staring at energy majors like Exxon, the real money, the serious alpha, is being made in a highly contested 21-mile stretch of water. Let's get right into it.
Okay, so let's really dive into this idea. The true alpha right now, it is not in buying traditional oil stocks. It's hidden deep within the maritime logistics supply chain. You see, when a major geopolitical event kicks off, the automatic retail reflex is to just blindly buy Exxon or Chevron and wait for it to go up. But right now, there is a massive, fundamental disconnect between the physical delivery of a commodity and the rapidly escalating cost of actually moving it across the ocean. The smartest capital in the market knows this. They are entirely bypassing the commodity itself and focusing directly on the economics of that narrow maritime corridor.
To understand why, we have to look at the physical reality of the Strait of Hormuz. It is an incredibly fragile corridor where a massive portion of the world's energy has effectively been bottled up by the ongoing conflict. At its narrowest point, this choke point is just 33 kilometers wide. To put that into perspective for a second, that's roughly the distance of a standard daily work commute for a lot of people. It's tiny, yet it handles a fifth of all global crude. When hostilities escalated and blockades were established earlier in 2026, the traffic didn't just dip, it completely collapsed by more than 90%. We went from seeing an average of 130 massive ships transiting daily down to just a handful.
So the absolutely crucial takeaway here is that 20% of the entire world's seaborne oil passes through this specific spot, along with 20% of global liquefied natural gas. When you violently rip that massive volume of energy out of the global supply chain literally overnight, it creates an immediate, systemic shock. The cascading effect of this deficit doesn't just bump up the price at your local gas pump, it starves massive industrial supply chains all over the globe. If this choke point remains highly restricted or closes entirely, a $5 gallon of gas is the floor. It is definitely not the ceiling.
Section 1. The Brutal Contango Trap. Retail versus Reality.
Let's unpack a structural market mechanism that is currently just devastating uninformed retail portfolios. We really need to understand a concept called contango. Basically, it's a hidden decay mechanism that destroys wealth for average investors who try to hold commodity ETFs over a long period of time. Think of contango like renting a rapidly appreciating storage unit for an asset that is actually slowly expiring. A lot of retail investors default to instruments like the United States Oil Fund, or USO, thinking it's a smart way to play the Hormuz crisis. But here's the catch. USO doesn't actually hold physical barrels of oil in a vault somewhere. It holds futures contracts. And when the market is in contango, the fund has to constantly sell its expiring cheaper contracts and buy newer, more expensive ones to maintain its position. So, you are essentially paying a hidden holding tax every single month, literally buying high and selling low, even if the actual real-world price of oil stays completely flat.
And that leads us to this brutal divide in the market. Retail traders buy into funds like USO and end up suffering a 15 to 20% principal loss just because of this structural decay. But the institutional players, they completely avoid that trap. Instead, they are capturing massive alpha through freight arbitrage. You see, even if oil prices stay sky high, the structural mechanics of contango and that negative roll yield act like a massive, continuous drain on your capital. The real gains aren't found in passively holding a liquid commodity ETF, they are found in the highly specialized derivatives of the shipping industry. It is entirely about capturing the spread in logistics.
Section 2. Logistics Alpha. The Blockade Playbook.
So let's pivot away from that retail trap and look at exactly how the smart money is generating massive returns during this historic disruption. While everyday investors are stubbornly buying oil, where are the hedge funds actually hiding? I want you to really ask yourself this question, because the answer lies in a corner of the market that's probably completely missing from your portfolio. When a physical global choke point is severed, institutions don't just place bets on the price of the commodity itself. They bet on the exponential cost of moving it.
The data completely exposes this logistics alpha strategy. Just take a look at the BWET Crude Tanker Futures ETF. As of May 2026, it had surged an absolutely astonishing 699% year-to-date. Compare that to the broader market, which was sitting at a very modest 4.1% return, right? It's wild. So why exactly is this happening? It's because vessel scarcity is driving up freight rates exponentially. Ships that used to do a quick transit through that 21-mile strait are now forced to reroute all the way around the continent of Africa, down past the Cape of Good Hope.
That massive detour adds 10 to 15 days to transit times, which effectively acts like a sponge, just soaking up all the available global vessel capacity.
The brutal, underlying truth of logistics alpha is this. When a choke point closes, securing the physical transport mechanism becomes infinitely more valuable than the commodity itself. The value isn't the commodity in the tank, it is the ability to move the tank. And compounding this whole issue is a solid decade of chronic underinvestment in the global shipping fleet prior to this conflict. Global shipyards are fully booked for years out, so when the blockade hit, there was absolutely no spare capacity to absorb the shock. You simply cannot print a new crude tanker overnight.
Section 3. The Weaponization of Maritime Insurance.
Okay, let's shift gears and look at the most potent yet completely invisible weapon actually enforcing this blockade, commercial risk logic. Because the military action is really only half the story. The ultimate barrier is financial. The big marine insurers over in London essentially closed the strait without firing a single shot. How? By spiking war risk premiums by an unbelievable 2,400%. Before the crisis, if you had a tanker valued at, say, $120 million, you'd pay around $48,000 in insurance for a 7-day transit. Fast forward to the peak in April 2026, and that exact same transit suddenly cost $1.2 million. Maritime trade is literally impossible without this insurance coverage. So when these clubs reprice the premiums at those extortionate levels, they turn standard, everyday transits into multi-million-dollar liabilities. They financially sealed the corridor.
And because these massive ships now have to reroute completely around the Cape of Good Hope to avoid those insane risks, daily charter rates for very large crude carriers, what the industry calls VLCCs, have skyrocketed to a catastrophic $800,000 a day. Just let that sink in for a second. $800,000 a day. That means you are burning through the equivalent price of an average American home every 12 hours just to float on the water. Every extra day added to that journey, every extra gallon of maritime fuel burn is directly pricing into the base cost of global logistics.
Section 4. Decoding the BDI and volatility.
Now that we understand the physical bottlenecks and the financial stranglehold, we need to look at the technical lead lag indicators that actually let you track this arbitrage. Look at the chronological flow of risk here. An initial geopolitical shock, say a kinetic strike, doesn't just vanish. It organically translates into a sustained spike in the Baltic Dry Index, or BDI, as maritime fear removes global shipping tonnage. Unlike the immediate knee-jerk reaction you see in oil prices, the BDI operates on more of a biological lag. It takes roughly 3 to 6 months for that raw geopolitical uncertainty to fully translate into sky-high shipping rates. So day 1 is the strike. Week 1 is that immediate insurance repricing we just talked about. Over the next few weeks, true physical vessel scarcity sets in, and finally, by month 3, labor contracts are renegotiated, supply chains start to snap, and the BDI absolutely spikes.
And listen, if you are trying to hedge against this kind of disruption, staring at the standard VIX is a huge mistake. The standard VIX measures broad equity volatility. It completely fails to capture the intricate, messy nuances of physical supply chains. Instead, the OVX, which is the Crude Oil Volatility Index, is a far superior tool. During the 2026 blockade, the OVX surged to its second highest level since 2010. This is highly valuable alpha. The OVX cuts cleanly through all the broader general market noise and proves to be the exact targeted instrument you need for capturing specific energy supply chain disruptions.
Section 5. Systemic Shock, the Macro Ripple.
Let's zoom out for a minute, because this crisis goes way beyond what you pay at the gas pump. It is currently acting as a systemic shock to the very building blocks of the entire global economy. This isn't just an energy story anymore, it's a food and materials story. The Persian Gulf region exports over 30% of the world's urea, which is an absolutely critical nitrogen fertilizer synthesized from natural gas. When the strait closed, 280 dry bulk fertilizer ships were suddenly left stranded. Let's walk through the literal domino effect here. Constrained natural gas immediately limits urea production. Stalled urea means stranded fertilizer, and stalled nitrogen fertilizer deliveries today mathematically guarantee massive crop yield failures tomorrow. It's not speculation, it's biology. Current trajectories point to a devastating 40 to 50% maize yield loss in Africa, which cements severe, unavoidable global food inflation for 2027.
To survive this kind of macro ripple, institutional capital is executing what's known as the halo rotation. They are aggressively migrating away from those intangible software-as-a-service tech stocks that defined the last decade. Instead, smart money is pouring into companies with heavy assets, logistics, and physical operations, HALO. The broader market has violently woken up to the fact that in a fractured, deglobalizing world, an app on your phone is not going to feed you.
Controlling physical supply chain infrastructure and heavy, tangible assets now commands a massive geopolitical premium.
The 2026 crisis has forcefully reminded the market of one indisputable, unavoidable fact. You cannot download a barrel of oil. You can't download a ton of fertilizer or a shipping container of medical supplies. Despite all of our incredible, mind-blowing advancements in AI, machine learning, and cloud computing over the last few years, the physical realities of energy, agriculture, and maritime logistics simply cannot be digitized. At the end of the day, the modern world still runs on heavy iron moving through salt water.
So, I'll leave you with this provocative thought to consider for your own portfolio as we navigate this. In a world increasingly fragmented by kinetic warfare and closed borders, are physical logistics moats the only true hedges left? When global choke points suddenly close, who actually owns the tangible infrastructure required to keep the world moving? Because as we've seen today, the real wealth isn't in guessing the daily price of a commodity. It's in controlling the vessels, the insurance, and the logistical moats required to actually deliver it. Thank you for joining me for this explainer. Keep your eyes on the data, and we'll see you next time.